equity markets have performed well in 2024 so far, with some volatility related to sticky inflation and evolving interest rate expectations. The European Central Bank started its cutting cycle in June and did another cut in September, whilst the US Federal Reserve was more hawkish in their tone and is only expected to make the first cut in September. The market focus will be on magnitude of rate cuts by major central banks over the next 12 months. We saw a lot of election activity this year so far. Europe, France, UK, Mexico, Indonesia, India, and others have already cast their votes, and activity has ramped up as we draw closer to the US elections due to take place later this year. Market performance was dominated by technology stocks, which have continued to show strength, buoyed by the theme of artificial intelligence. Whilst gains in US equities were again driven by the Magnificent Seven, performance within this group was mixed in more recent months. Nvidia has been the strongest performer by some margin, followed by Meta Platforms. Tesla's share price performance, in contrast, is in negative territory. On the other side, both healthcare and consumer stocks were weaker. For healthcare, this has in part been driven by weak earnings momentum, especially in pharmaceuticals and biotechnology. However, the sector is facing some headwinds such as overcapacity and excess inventory since the end of the COVID pandemic. We have now seen an end to the destocking, and companies are beginning to invest in expanding capacity. A recent bounce since July suggests to us that we are beginning to enter a more normalized cycle, and we are optimistic that these shorter-term headwinds are abating. Within the consumer sector, luxury goods have particularly struggled due to factors impacting luxury spending from both US and Chinese consumers, in particular the aspirational cohort as opposed to the top end. We believe a recovery in US consumers and gradual normalization in Chinese consumer spending should drive continued growth in the sector, although that recovery could be pushed into 2025 given the more recent consumer sentiment trends. In our view, the bigger picture remains that while shifting interest rates expectations may drive further style volatility in the nearer term, quality growth, the type of stocks that we like, should be more supported in general as we now enter into a rate-cutting cycle by major central banks. With the prevailing market backdrop, we continue to see companies with resilient earnings growth because of the ongoing risk of estimate downgrades and that have pricing power. Over the next 24 months or so, we think that we will see more disparity between companies that can protect their margins and those that will struggle because of stickier inflation. That is why it is so important to focus on firms with solid balance sheets and exposure to structural growth drivers. They are the ones which should be able to withstand this backdrop and succeed in the long term in our view. Importantly, as long-term investors, our portfolio consists of high-return compounding businesses with continued solid fundamentals and outlook. We are confident that they are well positioned to continue to benefit from structural growth drivers in what remains a low-growth environment.